Welcome to Trends with Benefits, an award-winning podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Hi, I am Ed Lopez, and this is Trends with Benefits. My guest today is Matt Apkarian. He's Associate Director, Product Development at Cerulli Associates. And today we're going to be talking about models. Not the Victoria's Secret variety, but investment models. And investment models have become a key way that many of us get invested in the markets or get invested in diversified portfolios. And from my sense, Matt, I feel like there's been tremendous growth in the space. And maybe I'm coming from a product provider standpoint and seeing the importance that models have in terms of product distribution. But I also get a sense that more and more investors and their advisors are using models as well. First off, welcome, Matt. And is my sense correct?
Yeah, you're absolutely correct. I mean, we're seeing some strong growth in model portfolios as a whole. And through the conversations that I've had with a lot of model providers, it still has been somewhat slower than they originally expected. I think that there is still somewhat of a disconnect between the perceived value added by financial advisors and how it affects what their value proposition is, and then the true value added coming from the model providers themselves in providing these asset allocation strategies. So there's still a viewpoint that things will continue to accelerate and that we'll see some sort of cliff occur where models adoption gets spurred even greater than we've seen. And I can discuss a few of those reasons as we go through today.
Yeah, absolutely. And maybe we can take a step back a little bit and talk about Cerulli Associates, your role there. One of the reasons that I wanted to reach out and talk with you guys was the research report you did on models, which was super comprehensive. But perhaps you can talk about Cerulli and the type of work that you do.
Sure, yeah, I'd love to. So Cerulli is a global strategic research and consulting firm. We have offices in Boston, London, and Singapore. Now, we only focus on the asset and wealth management industries, yet we're not an asset manager of any sorts. We don't manage assets. We don't provide investment recommendations. What we do is offer syndicated research reports and management consulting services to many of the world's largest asset and wealth managers. So we derive this research from over 50 surveys each year of retail and high net worth investors, along with financial advisors and wealth managers, home offices, private banks, family offices, pensions, insurers, investment consultants. We really try to cover all aspects of the asset and wealth management industry. And then we interview executives from the same audiences to contextualize our data. And so both our information providers that we use to formulate our research and our clients are asset and wealth managers.
So talk a little bit about the type of work that you're doing. Obviously, we're going to be talking about models. I assume you're doing research in models. Are there other areas of the asset management industry that you've been focused on?
Certainly. So we research four main pillars here at Cerulli that include institutional, retail, wealth management, retirement, and then product development. And that's where I sit. I'm on a team of 6 total. We cover all things investment product initiatives from both the asset manager lens and from the advisor lens. So we look at things like advisor product use as well. We are vehicle agnostic, so we do research across mutual funds, ETFs, alternative vehicles, model portfolios, really look across the full spectrum there and try to not only look at what the trends are at the leading edge of product innovation, but also look at what's happening in product management and for legacy product suites as well.
As we talk about models, perhaps we can level set and you can explain what we're talking about. What is a model? What are they generally comprised of? When we start talking about models, what should people think about?
So Cerulli defines an asset allocation model portfolio as a asset allocation strategy that's aimed at providing advisors with a full or a partial portfolio solution that's comprised of several investment strategy components. And one question that I get a lot, and I'll front run, is that we look at them slightly differently. They are a separate product offering from model delivered separate accounts, which are typically used to deliver a single strategy for the end investor client, whereas in an asset allocation model portfolio, you're typically delivering multiple strategies. And so the building blocks of these portfolios include mutual funds, ETFs, and separately managed accounts. We may start to see some other building blocks included in there as well, but that's really the core of what's included in an asset allocation model portfolio. And so we're seeing them, model portfolios are increasingly open architecture products. They're not just using a single vehicle type. They're using a combination of ETFs and mutual funds for higher net worth clients. They're also starting to slip in a lot of separately managed accounts for typically larger sleeves of the portfolio, such as U.S. equity, international equity. We're also increasingly seeing them using ETFs over mutual funds, which makes a lot of sense based on the proliferation of the ETF industry. A lot more asset managers are providing ETFs nowadays. And particularly, we're seeing the explosive growth of active ETFs occurring within the industry. And then just to touch base on SMAs again, the viewpoint of a lot of model providers is that the future of model portfolios is models of SMAs. And the proliferation of technology that enables models of SMAs, such as buzzwords such as direct indexing, and a lot of these discrete technology providers that can allow fractional share portfolios to be used as building blocks of these SMAs will further push that trend, and who knows, maybe someday they are really the core building block of these model portfolios.
Yeah, there seems to be a confluence of trends kind of happening in model portfolios, whether it's technology, product development like ETFs, fractionalization like you talked about, direct indexing, a lot of things happening there. Give me a sense, when I first started out, I talked about how I thought the space has really grown. Do you have any stats around that? Like how big is the model business or, assets in models today?
That's a great question. And so we've put a lot of effort over the past few years into finding a optimal way to segment the market. And so we use a survey of typically over 1,000 financial advisors each year and how they are primarily constructing portfolios. So keep in mind, as I discuss these stats, it's based on their primary way that they're constructing portfolios, not necessarily the way that they're constructing all of their client portfolios. But we bucket advisors into three groups. The first group being outsourcers, which are truly outsourcing their portfolio construction. They are advisors that understand that it's not a core part of their value proposition. A third party is making almost all of the investment decisions for that cohort of clients, for their main cohort of clients. The size of that market is about $2 trillion. So that's about 7% of advisory assets. Now, I'm estimating these numbers because we're still working on crunching the updated figures for our 2022 report. So I'm just adding a slight growth rate from what we saw in the 2021 report to get these numbers. But we'll see what the exact ones are coming here shortly. The second cohort of advisor portfolio construction are what we refer to as modifiers. And these advisors are typically starting with some sort of model portfolio, but they are making changes to it. So they're not completely outsourcing all the discretion for the client portfolio, but they're starting with a framework and they're adjusting based on specific client needs, or maybe it's based on their opinions which may differ from the model provider. We see that segment at about $7 trillion, or about a quarter of the advisory assets in the U.S. And then that leaves about 19 or so trillion, about just over 2/3 of the industry, which are true insourcers, which are building bespoke, custom portfolios for each individual client. And as I'll discuss a bit further, we view a significant portion of that segment really should not be constructing individual portfolios for each client, or may not be able to continue doing that as they need to continue to scale their businesses in order to combat the fee compression that's affecting the industry as a whole.
And so you mentioned that while you concurred that the size of the model business has grown, that a lot of model providers thought that it hadn't grown fast enough. Can you explain that?
Yeah, so there's been quite a bit of resistance, and when I'm speaking with these model providers and they're talking to us about their what the feedback they're hearing from distribution teams, a lot of advisors do really still believe that they're part of their value prop, or significant part of their value proposition to clients is the investment portion of advising a client. And if you really sit back and think about it, as an advisor, you have client relationships, you have run the business initiatives, and then you have investing. And I had a good conversation with a model provider one day that said, you can really do two out of those three things, but it's really hard to do all three of those things: to be a good investor, to be a good client relationship manager, and to be a good business person as well. And so I think that the investing portion of what advisors traditionally believe their value proposition is the most justified to be outsourced, because these model providers, these asset managers, who all they do is spend their 40, 50, 60, 80 hours a week, depending on who it is, just doing investing. They have access to better information. They have access to larger teams. They have really strong relationships with the companies that are included in their portfolios. It just really makes sense that these asset managers will be able to do a better job than an advisor who's also trying to manage a book of 200, 300, 500 clients at any given time. That to think that they will be able to still effectively manage a client portfolio and manage their clients and scale their business, I don't think it adds up for a significant portion of the industry. And so, we view that just under half of advisory assets could still exist as, true insourcers that are building custom bespoke portfolios for each individual client, where something more like 35% of the industry should be truly outsourcing portfolio construction. That includes, the 7% that we said already are, and another 28% that are building custom portfolios that really should be using models. And then that leaves about 20% of the industry as well that can still be that modifier or mosaic user segment, which will use information from a variety of different sources. They might start with the model. They might use multiple models. They might use a combination of internal and external resources for client portfolio construction, but they're not, truly only using internal resources and internal IP to construct their client portfolios.
Yeah. So, gosh, maybe it's now been 20 years. Early in my career, I was at a consulting firm, and we did asset allocation consulting. And we would develop asset allocation models that found their way into, I guess, annuity products, sometimes 401k products. Mutual fund companies would offer models of their asset allocation models. So it's right now, as I think back on it, I feel like models in a certain form or fashion have been around for a long time, but in my perspective, more recently have become more important, more pronounced in our business, or the business that I find myself in. In your opinion, what's changed over the last 10, 20 years? Are these asset allocation models different than the models that people will find today?
Yes, they're definitely different. We discussed a bit earlier in terms of the building blocks that's being used. Model portfolios used to be basically strictly bundles of mutual funds. If you think back into the 80s, early model portfolios were just it was a portfolio of mutual funds, and then proliferation of ETFs occurred in the late 90s and the early 2000s. And now we're seeing, again, the ability to use fractional shares in SMAs, which makes them, much easier. Otherwise you couldn't really use an SMA as a building block for a model portfolio for any client that has less than at least $2, maybe more like $10 million, because of, the price of individual shares of some of these stocks. So things are definitely changing. But then I also think, in the industry, what's different about the model portfolio industry today is that it's becoming increasingly necessary for advisors to use these, because of I think the main driver is this pernicious loop that has been created by fee compression, where scale is necessary to counteract fee compression. And then once these firms have larger scale, then they're able to continue to compress fees. And it's just, creating that loop and making it so it's, I don't want to say winner take all, but few take all, where there's small portion of the model portfolio industry that make up a really significant portion of assets. But we are starting to see, and that portion of the model portfolio industry are really those broker dealers for the most part that have significantly more model assets than asset manager model providers. But asset managers, and as well as third party strategists like ETF strategists, are actually growing at a much faster rate than those broker dealers nowadays, and we think that we'll continue to see those asset managers and third party strategists start to break out of where they currently sit, and if you're looking at the scale of top model portfolio providers, in the top 25, it's almost all broker dealers, and then in the bottom, in the next 25, 26 to 50, you see a lot more asset managers and third party strategists, and they're just going to keep pushing their way up in the leaderboard over time. I believe.
So with the compression of fees, that has forced advisors to concentrate on scale, right? So it's kind of what you're saying. So in order to get scale, they needed to be more efficient and therefore perhaps outsource models to help manage their client base as they grew that. Did that also lead to, I assume that also led to, different product usage like ETFs, which tended to be cheaper than mutual funds. What else? How did technology help in this space?
So technology has made it easier for these model providers themselves to be able to offer more products at scale. And actually, outside of what we typically know as the model portfolio industry are known as off-the-shelf models. So, anybody that accesses one of these models through a marketplace, they're getting the same product, whether it's an advisor at, ABC Advisor and, Tempe, or whether it's at XYZ Advisor in New York City. They're getting that same model. They get the same trades for any client that's in that model. Now what we're starting to see, because these model providers are able to manage more products at scale as well, is they're starting to do custom model portfolio projects for an individual client. So this might be like an individual broker-dealer home office, or it might be typically larger RIAs, but these certain clients might be able to go and say, we like the way you're constructing this model portfolio, but we really like these managers that we want you to include there instead, or we want you to make this same offering that you currently have in a tax-aware manner. So start to include, more ETFs, for example. And so all this technology is continuing to make it easier for the model providers to manage strategies, and then also to trade thousands, hundreds, thousands, potentially even millions of portfolios. We're starting to see increasing capabilities that are helping, I believe, with the adoption of model portfolios, because there still is that sense of I'm, as the investor, receiving something that is unique to my personal situation, which I think is really important.
Are you seeing the use of models for the implementation of a full asset allocation, an allocation model that has stocks, bonds, commodities, whatever, just the one and done kind of model for a client? Or are you seeing models being used in some thematic applications where they might have multiple models for different sleeves of their total asset allocation?
Well, we see that as well, because outside of, most model portfolios are target risk or risk based. There's some like 60-40 portfolio. They might have a several bands. There might be, 9 different allocations, or maybe there's 101 different allocations for every, 0 to 100% of equity that's in the portfolio. But there's also investment objective completion models that may target a specific objective, such as income. That seems to be the big one. But then there's also others which could be single asset class, could be single strategy. They will target certain, just like you mentioned, thematic exposures. There's a lot of different, more unique model portfolios that are coming to market now, and a lot of model providers believe that those models are going to be necessary to continue to be relevant in the industry and to provide something that's not commoditized. So what can you do to provide something that's unique to the market to help you continue to attract assets, even if it's, and it is, a relatively small portion of model portfolio assets? We're still seeing 80 to 90% of model portfolio assets go to target risk and risk-based models, but those investment objective completion models, for example, are at least gaining some ground.
Yeah. And you said you're seeing trends in terms of income models, or perhaps alternative income models?
Yeah, and I think it makes sense. Over the past 5 to 10 years, income has been a struggle to find income models that, we're able to find income exposures, alternative income exposures, equity income exposures. Those are probably the largest portion of the investment objective completion model segment.
Do you guys have a sense of how many models there are? And you mentioned proliferation of models. Is that a obstacle for advisors and or investors? Just the sheer number of them?
So in terms of the sheer number of models, I mean, there has to be. This is probably a shot in the dark, but a couple thousand. We'll just say a couple thousand. I mean, there's a lot of different product out there. And I think that the average number of more unique, so again, investment objective completion models, we're starting to see more and more of those for any given model provider. And I think that will continue to be the focus of product development for a lot of model providers.
Yeah, I can believe that, especially with the volatility in the market and just kind of the where we are in terms of the interest rate cycle and how the 60-40 portfolio has been broken for a while. Maybe that's going to get fixed, but people looking for different alternatives now.
Yeah, it's interesting. I hear that the 60-40 portfolio is dead. I feel like I see an article about that every day, and then I feel like I see another article each day about why it's not really dead. It's just changing a little bit.
Well, we'll see where we are after this interest rate hiking cycle, and maybe that'll offer some opportunities again. Do you think investors care if their advisor uses models for them?
A lot probably do. I think that communicating effectively the value of a model portfolio is one of the hardest things for advisors to do. Or might not be necessarily one of the hardest things for advisors to do, but it's one of the biggest blockers to advisor adoption of model portfolios. Because again, they want their clients to. The clients want to believe that they are receiving something unique, individualized attention for their given situation. But you kind of have to separate out there's financial planning and then there's investing, and they're two different things. And there's way more attention focused nowadays on the value that can be added through financial planning. Advisors can still make sure that they fully understand the goals and risk tolerance, et cetera, of their given clients and unique circumstances for that client, and then get them in, make sure that they're in the correct strategy, which then the model provider can provide that as their value prop. I think that it has to be getting better and more well received by investors because of the fact that we're seeing greater adoption among higher net worth individuals nowadays as well, and that models are continuing to grow at a decent rate. There's an expected cliff that will be occurring at probably some point in the next decade, where adoption of model portfolios will really spur, and a lot of that has to do with the aging advisor demographic, where older advisors typically think that their value proposition is still investing, or a significant portion of their offering is investing, and younger advisors are coming up through their education and learning about model portfolios early on in their career, seeing the capabilities of model portfolios, that you're still able to offer a unique solution to your client even if the model is trading a certain portion of that client's portfolio. And so as younger advisors continue to build their books of business, assets are inherited by younger members of families as well. We'll start to see more and more assets transition, and it could be a pretty quick transition that occurs at some point over the next decade or so.
Yeah, I could see that. Some of the younger advisors also having grown up with technology and probably more comfortable with technology and use that for efficiency's sake as those assets transition, that wealth transition happens. Yeah, that could be interesting to watch.
Yeah, and as fees continue to come down as well. I mean, I know we haven't really discussed fees yet, but that was another big blocker for the use of model portfolios, was the perception of fees associated with them. And when you look at everything that the all-in fees for a model portfolio, there's two main parts nowadays. The main part, the biggest portion, is the expense ratios of the underlying product. So mutual funds, ETFs, SMAs, typically ETFs, which are used mostly for indexing, and passive exposures are going to be the cheapest. Mutual funds are still more typically used for active exposures, so they'll be a little bit more expensive. And then the SMAs are typically going to be a bit more expensive as well. And then, outside of the underlying component fees, the underlying building block expense ratios, then you have the actual fee for the model, which can be anywhere. It can be a few basis points. It can be upwards of 40, 50 basis points, I think. And most often we're hearing it in the 20 to 30 basis point range for the actual, fee for the model portfolio. So when you add that on top of generally about 45 basis points for the, asset weighted expense ratio of the building blocks, then you're looking at about 70, 75 basis points, which is right around or cheaper than a lot of these managed account programs can be otherwise. So if you're able to offer, financial planning, I'll take a step back. The other portion for any given advisor is then the fee that they are charging. So there's going to be the fee of the underlying investment vehicles, the fee for the model portfolio, and then the advisor fee as well. And so as the fees for model portfolios and fees for underlying building blocks continue to come down, it could make the offering for any given advisor, especially as they're able to scale, even more attractive if the end investor realizes that they're still getting a good return or a good fee adjusted return, even though they're in a model portfolio, which in the end the performance probably won't be all that different than whatever custom solution, or may in many cases be a lot better than the custom solution, because an advisor can't spend as much time as they should be on their individual client portfolios.
Now, so what do you think that advisors and investors should consider when selecting a model?
One of the things is the portfolio construction type, or the strategic versus tactical decision making of the model provider. So, I think most asset managers, or I know that most asset managers nowadays will, stick by their strategy and, through all different types of market conditions with, minor tactical changes, saying that we're investing for the long term. That's how we feel that our investors should be investing for the long term. So most, traditional asset managers have that viewpoint. It's the hedge fund and alternative world that, like to make a lot more tactical changes more quickly and try to make, short-term alpha. But I think it's important to make sure that based on the risk tolerance of your investor, that that you're aligned with the proper portfolio for that given client. Now, as I discussed before, a lot of target risk models are somewhat commoditized. So, at Cerulli, none of our research looks at, who is performing the best from an actual alpha or market performance standpoint. We just in general take the viewpoint that all asset managers will deliver approximately the same performance, and we're looking at factors that will that the strategies that the asset managers are using to attract more assets from a business development standpoint. It's important to look at the model architecture as well, so that can include both the vehicle choice for any given model, as well as the asset managers of the building blocks, and make sure that it aligns with what would be in the best interest of that given client. Hopefully that is a mold that advisors in general will be able to break out of, understanding that these model providers are doing extensive manager research and making sure that they're selecting the best managers for any given building block for that portfolio.
Okay, so what's one long-term trend you see playing out over the next year or several years?
Long-term trend, I think that we will start to see significantly higher usage of SMAs within model portfolios. And two things driving that. One, just the fact that the technology is making it easier to use SMAs, but also the continued and faster adoption of model portfolios that's occurring in higher net worth individuals as they get more comfortable. Or maybe these are individuals that have been in model portfolios all along and they're just becoming high net worth as well. One trend in general in the asset management industry that we've been hearing a lot lately is a focus on what they call Henrys, so high earners, not rich yet. They're focused on building relationships with clients who might not have a high asset base just yet, but they're young, they're high earners, they're going to be high net worth individuals in the future. Let's make sure that we're building relationships with them young. And they might be in a model portfolio when they only have, $100,000, $250,000 of assets. But as they continue to grow and get in that mass affluent and then a high net worth client segment, then, that will, help contribute them and make sure that they're, retaining that client over time. So SMAs, I think, we've heard a lot that so far direct indexing, huge buzzword, tons of stuff in the news about it. It's been a crowded conversation, but not yet a crowded trade yet. And so one of the key focuses of a lot of asset managers that are considering using like direct indexing as direct indexing SMAs as a portion of these model portfolios is for which client segments does it really add enough value? So what I mean by that is, yes, you get increased tax management, but direct indexing doesn't help in if they have a significant portion of retirement assets relative or non-taxable assets compared to taxable assets, and SMAs have higher fees than ETFs or mutual funds as building blocks. So you got to make sure that SMA, that direct indexing product that might be used in a model portfolio, is truly adding enough value, and not just making it look better by the client holding individual stocks as opposed to mutual funds and ETFs.
Yeah, that's great. That was going to be one of my trend or fad questions for you. So direct indexing, but I've got more. You ready for trend or fad?
Sure.
Okay, I'm going to ask you about maybe 3 to 5 different topics, and you give me your quick answer, trend or fad, and you can explain it if you like, but you don't have to. Hybrid work, trend or fad? So
I think that hybrid work will continue, but I think in many cases the leash will get tightened a little bit. I think that it's really tough to incorporate new associates that are fresh out of college in the corporate world and get them used to company culture when they're 100% working from home. And so we see a lot of value added when we have time spent in the office and connecting with colleagues. So I think that while there will the hybrid part of of working that the pandemic had brought along will not disappear, but I think that you're going to start to see a little bit more structure around when they'll need to be in the office versus be able to work from home. Thematic investing, trend or fad? So my colleague Daniil, who covers ETFs very closely, and I've been talking about this a lot lately, and it seems to be a trend that has somewhat played out already. But the funny thing is while a lot of these funds are not continuing to attract assets, they're not losing those assets that they attracted either, even though a lot of these portfolios are getting smoked right now. They're down 60, 70%, et cetera, with a lot of these, non-profitable tech names, for example. They're still maintaining the assets. Like the money isn't flowing out via flows. They're dropping in assets due to performance, but not due to flows. So, I think that a lot of those portfolios were likely fatty and may start to get rationalized. We'll put it that way. And then pickleball, trend or fad? So pickleball is the new spike ball, I think. Is it going to totally upend tennis? Are we going to start seeing pickleball played at Wimbledon? I mean, maybe not. I don't necessarily think so. I think tennis is the legacy there. But it's certainly getting a lot of attention right now. We've had a few new places go up in Boston here, even both indoor and outdoor. So it is very popular right now. But I'm going to go with fad. All right. And then let's see, finally, space tourism, trend or fad? I think it's got to be somewhat of a fad. I mean, but, I guess you never know. As the rich continue to get richer, maybe they're just going to need somewhere to spend their money and they're going to continue to want to go to space. If the wage and income gap continues to widen, then, we're going to see a quadrillionaire in my lifetime. So they'll need somewhere to spend it. Get them off the planet. Go ahead. Well, this is great, Matt. Thank you very much for your time. What's the best way for people to learn more about what you're doing, reach out to you, and connect? They can connect with me on LinkedIn. I also do have a Twitter account that I use as well, which is at Matt at Cerulli. So that's MATTAT Cerulli, CERULLI. So either of those methods as well. More than happy if somebody wants to, further discuss things that we discussed on the call today, or get in touch for somewhat of a informational interview. Happy to share ideas, data, and then we're always looking for people within an industry to join our survey pool as well. And just so everyone knows, whenever somebody completes one of our surveys, will automatically receive a benchmarking report for that survey. So basically, you'll see how your responses stack up to the rest of the survey pool, which I think can be a great resource and can make it worth the 5 to 15 minutes, depending on which survey it is that it takes to complete it for us.
Absolutely. Well, thank you again. Maybe when I'm in Boston next, we can go grab a game of pickleball and try that out. I've never played. But
Yeah, absolutely. Let me know. There's a few places nearby here. So
sweet. Well, thank you, Matt, very much.
Yeah, it was great to speak with you. Thank you so much for having me.
And thank you for tuning in to another episode of Trends with Benefits.